Range trading. Let's talk about how I look at the range, how I map the range, how I trade it. Ultimately, a range is sideways price action. Okay, it's when price is bound between a key high and a key low, and it's moving between these 2 points of interest, these 2 structure points, without decisive direction, so without expanding away from them. Okay, it's often referred to as chop, consolidation, sideways. You'll hear terms like accumulation, distribution, reaccumulation, redistribution. Ultimately, it's the same thing. It's just sideways price action. It's ranging price action. Okay, many people draw ranges different ways based on support and resistance. As with all trading strategies and systems, it can be very subjective. I look at market structure because I'm a market structure trader, and the range is always the price action between the most recent structure high and low. So in the context of this example, we've got a bearish structure, we've got a downtrend. So I take the last primary high and the current primary low, and that becomes my range high, my range low. So all the price action that occurs within these 2 key points are ranging price action. This is my trading range. Now, when I approach the range, I'm thinking about 2 things, okay? My intent. I've got to think about my intent with why I'm approaching a range. Now, it's either going to be I'm looking for a range trade, okay? And I'm only looking to trade the range, where I want to trade the extremes of the range and target the other side of the range, okay? Or I want to use the range to position for an expansion. So how do I make that decision, whether I just want a range trade or whether I'm in a position for an expansion? Well, I need to think about my bias, my thesis for what's going to happen next. So when I have a strong directional bias and when I believe there's a strong catalyst and a thesis for price to move in a specific direction, so say for example, in this instance, I believe price is going to expand up, then the best place for me to be positioning for this expansion is going to be utilizing this range to size into a position for this expansion. Now, in my trading system and in my strategy, I would much rather position into a range and then scale into my position further once price confirms the movement and starts the expansion. And I hate scaling into a position when I've missed the range and I'm chasing here. Okay, I'd much rather add to winners when price confirms the move in a direction than average down. Okay, it's not to say that I don't average down ever, but psychologically, I feel much better sizing into a position and then scaling that position when price moves in the direction in my favor. Now, let's first talk about if we were just range trading. So let's say we see price action that looks something like this, okay? And I don't have a strong thesis or a strong bias for where the price is going to expand next. So that's where I might say to myself, okay, let me just look at what setups present themselves for me to range trade. Now, when you're range trading, you want to be trading the extremes. So you want to be long from the range low and you want to be short from the range high. Okay? And the target is just the other side of the range. So in this instance, as price came down to the bottom of this range and provided a signal, maybe it was an SFP, maybe it was some other type of signal, a market structure shift on a lower time frame, whatever it is, I want to be looking for that signal to trade this back to the other side of the range. And the same into the high. What you don't want to be doing when trading the range is you don't want to be diddling the middle. Okay, so you don't want to be trying to trade this chop in the middle, because this is where essentially you just you're going to get chopped up, and you're also not getting the bang for buck in your trades if you're range trading. Okay, so I don't want to be going, short here and then long again here and long here, trying to short here. Like, this is where you're just going to get chopped up. You want to be on the extremes of the range. Now, if I was positioning for an expansion, for example, let's say I believe price is going to resolve to the upside. I had a strong thesis why price is going to move in this direction and expand after the range. Well, I want to start building my position and sizing into this position into the range. Okay. And I want to use some of the same concepts as when I'm range trading. I want to look at that behavior specifically around this low if I think it's going to move up, because that's going to provide me really good entries, the best price entries if I trade that extreme, and I can invalidate quite easily. And the other thing I want to think about is premium and discount pricing. Okay, so if you get a fib tool, I'll just show you my settings. I turn everything off. I like to use the dash line, and I just put a 0.5 up there. What that's going to do is, as you map the high to the low, it's going to show you the mid section of the range. Okay, as a general rule, this is considered discount pricing. This is considered premium pricing. If you want to be long on a market, you believe there's this expansion occurring, you want to be filling your positions in discount, because this is where you're getting the best bang for buck. You're getting the best price for your long position. And if you want to be short, let's say you thought this was going to continue expanding to the downside, you want to be filling your positions in premium pricing, because that's where you're going to get the best risk to reward. You're going to get the best bang for buck. Okay. Now, the other great thing about when you're either range trading or when you're using the range to position, you've got clear invalidation. Because if you're trying to go long on this range to position for a bullish uptrend, here's your invalidation, the range low. So once that you get that move after you've got your positions, you know that this range was an accumulation because it resolved to the upside. It would have been a distribution if it resolved to the downside. Okay. And this range should now be the base for this price action. So as it moves to the upside, typically what you might see is it'll make its first move. It'll come back down to mitigate the range before moving up. This is where I might scale into some more positions. But ultimately, I know that once I start positioning in the range from down in this point, I can keep my stop under here, because if it breaks down, we know that I'm wrong and I can invalidate my trade really easily. So just to recap on what we've gone through, a range, when price is contained within a high and a low and is moving sideways, the first thing you always want to think about is, am I range trading? Am I just going to trade the range? Or am I looking to use this range to position into the next expansion? If you're range trading, you're trading the extremes where you're shorting resistance, the range high, and you're longing the range low. Your target is the other side of the range. And when you're positioning for an expansion or the other way, you want to be using discount and premium as your guide for filling orders and positioning into that position. So if you believe that the range is going to resolve to the upside as an expansion, you want to be looking to fill your positions in the discount area. And if you thought the range was going to break down and expand to the downside, then you want to be filling positions into premium. The range also acts as your invalidation. If the range breaks down in the opposite direction of where you believe the market was meant to go, that's how you cut your trade. That's how you manage your risk.